The truth is simple, but brutal. If you don't understand how the market makers think, you will keep losing to them without even realizing it. Most retail traders believe they are trading against other small traders just like themselves. They imagine a level playing field where everyone has the same chance. But the market does not work that way. There are giants behind the scenes, the ones who move price, the ones who create liquidity, the ones who hunt stops and trigger emotions, and manipulate price levels with precision. These players have a playbook, and every new retail trader walks straight into it without knowing the rules. This chapter begins with one painful reality. The market is designed in a way where retail traders are naturally positioned as liquidity providers for the institutions. When a retail trader buys, someone is selling to them. When a retail trader sells, someone is buying from them. The market makers know where the clusters of orders sit, where the fear builds, where the greed spikes, and where the weak hands break. Their goal is not to move the market randomly, but to move it where money is trapped. They target the obvious stops, the predictable behaviors, and the emotional reactions that inexperienced traders cannot control. If you have ever wondered why the market always seems to reverse right after you enter, why your stop loss gets hit by one tiny spike before price goes exactly where you wanted it to go, or why breakouts often fake out first before becoming real, the answer is simple. You are being played by rules you don't yet understand. And that is exactly what market makers expect. They understand human psychology at a level that most traders never truly realize. They know that when price rises rapidly, most beginners chase it. They know when price drops aggressively, most beginners panic. They know where the obvious entries are, and they know where the obvious exits are. And they use that predictability against retail traders every single day. To understand how the playbook works, you must first understand the concept of liquidity. The market cannot move without liquidity. It needs orders on both sides. It needs buyers and sellers. It needs stop losses to trigger, limit orders to fill, and emotional traders to act without thinking. Market makers create these moments intentionally. They push price into zones where they know a large volume of retail orders is waiting. These zones are like pools of fuel. Once price reaches them, a chain reaction happens. Stops get triggered. Orders get activated. Fear spikes. Greed takes over. And suddenly, the market moves with speed, as if out of nowhere. But it was not random. It was intentional. When you watch a massive candle spike through a support or resistance level, you may think the market is breaking structure. But, in reality, many of those spikes are liquidity grabs. The market reaches above or below a level to take out stops, fill institutional orders, and then reverse in the opposite direction. Retail traders see the move and jump in late. Meanwhile, the institutions have already completed their accumulation or distribution. The move that retail traders think is the beginning of a trend is often just the final moment before the real trend begins. This is one of the oldest tricks in the playbook. Trap retail traders on the wrong side, take their liquidity, and then move the market in the real direction they intended from the beginning. Understanding this psychological trap is crucial because market makers design price movements around it. They rely on predictable behavior. They rely on impatience. They rely on panic. They rely on traders reacting to what price looks like instead of understanding what price is doing. Consider how the market behaves around key levels. These levels attract attention. They attract hope. They attract fear. Market makers know the exact price points where most traders place their stops. They know the standard strategy taught to beginners. They know retail traders love swings, highs and lows, love trend lines, love breakouts, love moving average crosses, and love simple patterns. But simple patterns without understanding liquidity make you an easy target. Before we dive deeper, let me ask you this. Are you struggling with fear, doubt, or overtrading? The truth is, most people don't fail because of bad strategies, they fail because of bad psychology. That's why I created my ebook, Master Your Mind, Master Your Trades. It's packed with practical steps to control your emotions, stay disciplined and trade like a pro. If you're ready to take your trading to the next level, check the link in the description and pinned comment and grab your copy today. Now let's continue. Imagine a common situation. Price has been trending down, and finally it forms what looks like a double bottom. The average trader sees this and believes the trend is reversing. They place a buy order, maybe even aggressively, because they saw a bullish candle and felt confident. But the market maker's goal is not to let that trader win immediately. The goal is to take out the buyers who entered early by pushing price just a little lower. Enough to trigger their stops. Enough to convince them the market is still bearish. Enough to create one more wave of fear. And then, once the liquidity is taken, the real move begins. Price reverses sharply upward, leaving the stopped-out trader confused and angry. They feel like the market is against them personally. They feel targeted. And in a way, they are. The playbook works because traders act emotionally, not strategically. When you enter a trade because it feels right, you become predictable. When you set a stop-loss based on a standard rule, instead of understanding structure, you become visible. When you chase a move because you fear missing out, you become vulnerable. Market makers find these vulnerabilities like hunters studying prey. They know the routine. They know the behavior. They know where you will act before you act. To break free from this trap, the first step is seeing the market from the perspective of the players who control price. Market makers are not trying to predict the market. They are creating the market. They move price in ways that benefit their positions, not yours. When you understand this, you stop taking price action at face value. You stop believing every breakout. You stop reacting to every wick. Instead, you start asking deeper questions. Why did the market move there? Who benefited from that spike? Whose orders were filled by that move? Was this move driven by real momentum, or just a liquidity sweep? These questions shift your mindset from being reactive to being analytical. You stop seeing yourself as a small participant, guessing what the market might do next. Instead, you begin to understand the market as a system built around incentives. And the primary incentive for market makers is simple. Take liquidity, then move price in the direction that profits their large positions. Most traders lose because they look at the market as a chart. Market makers look at it as a map of where money is sitting. There is a difference between viewing price levels as lines and viewing them as pools of liquidity. When you see liquidity, you see the real intentions behind price movement. You begin to spot the traps before they happen. You begin to recognize when price is being manipulated to gather orders. You begin to anticipate reversals not because of indicators, but because you understand how the playbook works. Let's dive deeper into the psychology behind stop hunts. A stop loss is a safety mechanism for retail traders. But for market makers, it is a treasure chest. Stops represent guaranteed orders. They are predictable, fixed, and unavoidable. If a trader buys and places a stop loss below a swing low, the market maker knows exactly where that order will trigger. So if the market maker wants to accumulate long positions, they will push price down into that pool of stops. When those stops get hit, they create automatic sell orders, allowing the institutions to buy from them at discounted prices. Once the liquidity is collected, price moves up rapidly, leaving retail traders stunned. This pattern happens every day, across all markets, across all time frames. And it happens because traders do not understand the playbook. Another classic move is the fake breakout. This is one of the market makers' favorite strategies. They know that retail traders love breakouts because they look clean and simple. When price approaches a key level, many traders get excited. They expect volatility, they expect a big move, they expect confirmation. So what does the market maker do? They push price slightly above the level to trigger breakout traders. The moment retail traders enter, liquidity increases. Stops below the level also become visible. So after capturing the breakout buyers, the market maker reverses price sharply, hitting their stops and collecting liquidity. Only after this liquidity grab does the real breakout happen. Retail traders who lost money now watch the chart move without them, convinced the market is unfair. And in a way, it is. It is unfair to those who do not understand the game being played. The deeper you go into the market maker playbook, the more you realize that their power does not come from controlling price alone. Their true power comes from controlling the emotions of traders who do not understand what is happening. Price is not just movement. Price is communication. Every candle is a message. Every spike is a signal. Every reversal is a reaction. Market makers use price to manipulate the belief system of retail traders. They create hope, fear, confidence, panic, hesitation, greed, and doubt. They use these emotions as tools to shape the behavior of traders and force them into predictable decisions. And once traders become predictable, they become easy to exploit. A trader who does not understand this psychology becomes trapped inside a cycle of emotional trading. They buy late because they feel FOMO. They sell early because they fear losing profits. They move stops because they feel discomfort. They close trades too soon because they want relief. Every decision driven by emotion becomes a gift to the institutions. The market maker's goal is not only to take your liquidity, their goal is to make you provide it willingly. To understand how deep this influence runs, imagine a scenario where price slowly trends upward. Every candle is slightly higher. Every pullback is shallow. The structure looks strong. Retail traders begin to build confidence. They believe they see the start of a trend. Their brains crave patterns, so they start to see meaning where there might be manipulation. They wait for a small pullback that aligns with a standard textbook pattern. Then they enter. Everything looks textbook perfect, but what they do not know is that this structure was engineered to trap them. The market maker's objective is to create reliability. When price moves smoothly, traders feel safe. They begin to trust the movement. They begin to believe that the market is behaving logically. And the moment they develop this trust is the moment market makers introduce chaos. Price suddenly spikes downward. The clean structure breaks. Candles become large and violent. What looked like a healthy pullback becomes a collapse. Retail traders panic. Many close at a loss. Some flip to selling. Some move stops further out. Some freeze. This confusion is not an accident. It is part of the playbook. Market makers create order so they can later weaponize disorder. They build confidence so they can later destroy it. They allow structure so they can later break it at maximum pain points. When you do not understand these psychological layers, you become another victim of the emotional manipulation built into the market. A key part of this manipulation is the concept of imbalance. Price rarely moves in a straight line. When it does, it is usually because institutions are executing large orders. These large movements create imbalances where very little trading occurred. Retail traders often chase these moves, believing they indicate strong momentum. But market makers know that these imbalances need to be filled. Price must often return to these zones to complete the orders left behind. So what happens is simple. Retail traders enter late, thinking the market is trending with force. The moment they enter, the market reverses, not because the trend is over, but because the institution needs to fill the imbalance they created earlier. This return to imbalance zones is not random, it is engineered. And the emotional trap is predictable. Retail traders see the reversal and think they have traded into a fake move. They panic and exit at a loss. Once price reaches the imbalance zone and fills it, market makers resume the original direction, leaving retail traders behind once again. This cycle repeats endlessly because traders act on emotion instead of understanding the intent behind price movement. Another critical part of the playbook is the manipulation of time. Market makers know traders hate waiting. They know traders crave action. They know traders enter early because they want to catch the move. So what do? They create zones of consolidation, where price moves sideways, slowly, painfully. The purpose is simple. It exhausts the patience of retail traders. It bores them. It frustrates them. It pushes them to make impulsive decisions. When price sits in a range for a long time, traders begin to predict breakouts. They begin to hope. They begin to feel pressure. They begin to fear missing out. And that is exactly the moment the trap is set. Most traders enter before the breakout happens, believing they are being smart by anticipating the move. But anticipation without confirmation is gambling. Market makers collect all those premature orders, and then they use them as fuel. When the breakout finally happens, it is often fake. Price moves just enough to trigger those early entries, then reverses sharply, wiping them out. Only after the liquidation does the real move occur. This is the psychological attack behind consolidation. It is not just sideways movement. It is a test of patience. It is a lure. It is a trap disguised as opportunity. And it works because traders underestimate how powerful impatience is as a weakness. Consider also the manipulation of news. Many traders think news moves the market. In reality, the news is just the excuse for market makers to move price in ways they planned long before the event. Hours before major news, price often behaves strangely. It moves into key levels. It sweeps liquidity. It creates specific structures. The reason is simple. Institutions position themselves ahead of time. They use the news event as a way to generate volatility and disguise their true intentions. When the news drops, the market often spikes violently in both directions. Retail traders interpret this as sensitivity to the event. But what is really happening is liquidation. Stops are being hit on both sides. Both buyers and sellers get swept in seconds. Meanwhile, the institutions get perfect entries, while retail traders get emotional whiplash. By the time the dust settles, the real move begins, usually in the direction opposite of where retail traders position themselves. This is why news trading destroys so many beginners. They think the spike is the move. But the spike is just the hunt. The real move is what happens after the liquidity is taken. To understand the playbook deeply, you must understand that everything revolves around liquidity. Liquidity is not just orders. It is the fuel that powers every large movement. Market makers cannot move the market without it. They need traders to take positions so they can take the other side. They need predictable behavior so they can exploit it. They need stops so they can collect them. This means that the market will always go to where liquidity is highest. It will seek out clusters of stops. It will gravitate toward obvious levels. And when enough liquidity has been collected, the real move begins. This is why the market often moves toward obvious support or resistance levels. Retail traders think these levels hold magical power. But the truth is much simpler. These levels are magnets because they contain large amounts of money. For institutions, grabbing that money is part of their job. They cannot fill billion-dollar positions in random areas. They need the liquidity that retail traders unknowingly provide. When you understand this, you begin to see the market differently. You stop fearing liquidity hunts. You start expecting them. You stop being surprised by spikes. You start reading them. You stop chasing structure. You start analyzing intention. Every move becomes clearer. Not perfect, but clearer. Another psychological tactic used by market makers is engineered volatility. Volatility is not always organic. Sometimes it is created deliberately to force reactions. For example, when institutions want to accumulate positions, they need retail traders to sell, so they create sudden drops in price. These drops look frightening. They trigger panic. They cause traders to exit trades prematurely. They push late buyers out of the market. And when retail panic reaches its peak, institutions quietly buy, everything being dumped. Then the market stabilizes and gradually rises again, leaving retail traders asking why they sold at the worst possible moment. They sold because they reacted emotionally to engineered volatility. This emotional response is what market makers rely on. They do not need to trick every trader. They just need enough traders to react predictably. The market does not move on logic. It moves on liquidity and emotion. The more emotionally unstable the retail traders are, the easier it is for institutions to manipulate them. One of the most painful lessons a trader can learn is that most of their losses come from not understanding the intentions behind price movement. They see a clean pattern and trust it. They see a breakout and chase it. They see a sudden spike and panic. But once they learn how to interpret these moves through the lens of liquidity, everything changes. They no longer follow the obvious. They follow the motive. The next layer of the playbook involves stacking traps. This is when the market creates a series of manipulations to lure traders deeper into emotional vulnerability. For example, price may fake a breakout, reverse, consolidate again, then fake another breakout. Retail traders get caught multiple times. Each time they lose money, their emotional control weakens. Each time they get trapped, they become more desperate. And desperation leads to oversized positions and impulsive trades, which provides more liquidity to the institutions. There's a moment in every trader's journey when they finally see the market without the filters, fantasies, or motivational quotes they used to rely on. It happens quietly, almost like a light turning on in a room you didn't know you were sitting in. Suddenly everything looks clearer. Suddenly the things that used to confuse you start making sense. And suddenly, the moves that used to scare you just look like someone else's trap. That moment is when you stop trading like prey and start moving like someone who actually understands the rules of the game. But you don't get to that moment by accident. You get there by digging through every layer of deception the market maker uses, and learning what each one is designed to do. It's only when you understand the purpose of their moves that you stop falling for them. One of the most important truths you eventually accept is that the market maker doesn't just move price. They move people. They move fear. They move hope. They move desperation. And they don't need to know your name to manipulate you. All they need is to know how the average trader reacts when they see a candle sprint in one direction. Because once you understand the average reaction, you don't need anything else. The play becomes predictable. Most traders see a breakout and jump in. Most traders see a pullback and panic. Most traders see a rejection and assume the entire trend is dead. The market maker doesn't win because they're smarter. They win because they play the crowd like a violin. And the crowd rarely changes. To trade against them, you don't need to be faster or more talented. You just need to stop acting like the crowd. That's the real challenge. Because the crowd's mindset is built inside every new trader by default. You don't even realize it. You think you're thinking for yourself, but you're reacting exactly how they want you to react. You're chasing exactly what they want you to chase. That's why the market maker doesn't need to search for liquidity. They know exactly where you left it. You left it at your stop loss. You left it above your highs. You left it below your lows. You left it in the places where your emotions made you behave predictably. That's why understanding the rule of engineered liquidity is the turning point of a trader's growth. Because once you see how they create the illusion of momentum just to harvest positions, you start noticing how often you fell for it. Think about the last time you saw a candle explode through a level after hours of sideways movement. Your heart rate probably jumped. You probably felt something inside scream that you were missing out. You probably clicked buy or sell without thinking too deeply, because the move looked too strong to be fake. But that move wasn't strong. It was intentional. It was planned. It was a magnet designed to pull in the impatient traders and squeeze the ones who entered too early. The market maker plays a simple, psychological game. They study how long the average person can wait before impatience becomes panic. They know when you're likely to give up. They know when you're likely to enter out of boredom. They know when you're likely to get angry enough to revenge trade. It's not magic. It's repetition. You're not the first person to fall for it. Millions of traders before you reacted the same way. So the market maker builds the same traps and waits for you to walk into them. Once you understand this, you start seeing why the market reverses exactly when it starts to feel safe. It's not random. It's the moment when the most people are finally convinced that the direction is real. If you've ever had a trade hit your stop loss by a few points and then immediately go your way, it's not because you're unlucky. It's because you placed your stop where everyone else placed theirs. And where everyone else places their stops is a gold mine for the market maker. Their entire playbook is built around collecting those zones one by one until there's nothing left but confused traders wondering why the market feels personal. But here's the breakthrough that separates confused traders from emerging professionals. When you start treating these moves as signals instead of attacks, everything changes. The stop hunt that used to annoy you becomes evidence. The fake breakout that used to embarrass you becomes a blueprint. The sudden reversal that used to destroy your confidence becomes a signpost telling you who's really in control. Because the market maker isn't hiding their intentions, their moves speak loudly once you know how to listen. One of the biggest lessons is realizing that the market maker can't move price however they like. They need liquidity to push it. That means they must lure traders into positions before they go the opposite way. They need buyers before they sell. They need sellers before they buy. That's why you often see a slow push up, a violent wick down, then a real move higher. People think the violent wick is manipulation, but the real manipulation is the slow push that built the anticipation. By the time the wick wipes out the early buyers, the market maker has all the liquidity they need to run the market upward with clean momentum. This is why patience becomes your greatest weapon. Not because patience is peaceful or wise, but because patience stops you from getting harvested. The impatient trader becomes food. The patient trader becomes invisible. And once you're invisible, you stop giving the market maker the liquidity they're waiting for. You start entering when the play is already set, not when it's still being engineered. You stop trying to predict the next trap and start waiting for the trap to complete. That shift is how a trader stops bleeding and starts seeing. Once you start recognizing the structure of manipulation, you begin to feel a strange calm. It's not that the market becomes easier, it's that you stop taking every movement personally. You stop getting emotional every time the candle does something dramatic. You stop assuming the market is against you. You finally understand that you were never the target. The target was always the group, the crowd, the herd. And once you stop behaving like the herd, the market maker no longer has control over you. But there's one more layer to their playbook that most traders ignore until it's too late. The emotional exhaustion phase. This is where the market moves just enough to convince you something is about to happen, then stalls in a way that drains your energy little by little. It's not volatility that kills most traders. It's boredom. It's doubt. It's the mental fatigue that builds when you watch price sit in a tiny box for hours and your brain begs you to do something. Anything. Enter. Exit. Adjust. Force a trade. The market maker loves this phase because the emotional tax you pay during it makes you vulnerable. You become more reactive, more impulsive, more desperate to feel in control. And once you're in that emotional state, your account becomes easy to read. To avoid this trap, you must become someone who lets the market reveal its intentions instead of trying to interpret noise. You can't rely on excitement to push you into a trade. You can't rely on boredom to convince you to enter early. You can't rely on hope to keep you inside a losing position. You need to detach yourself from the emotional rhythm of the chart, because the market maker doesn't need to beat your strategy. They just need to beat your reactions. And yet, even with all these manipulations, there's a hidden opportunity. Every trap they set also exposes their direction. Every fake move reveals the real agenda. The key is training your mind to look past the surface. For example, if price sweeps the high of a range and immediately falls with speed, you've just witnessed liquidity collection. That means the market maker grabbed what they needed and is now free to move in the opposite direction. If price sweeps the low and then pushes upward aggressively, you've just seen the bottom being engineered. If price consolidates for too long in a tight zone, you're watching pressure being built for a move that will catch most traders off guard. The moment you start identifying these patterns, you're no longer a victim of them. You start entering where others are panicking. You start holding where others are bailing out. You start profiting from the traps instead of falling into them. And your confidence transforms, not because you suddenly know the future, but because you finally understand the rules. There's a point when you realize the market maker doesn't hide from you. They operate in the open. Their footprints are everywhere. In the wicks, in the ranges, in the sudden pushes, in the liquidity runs, in the moments of silence before a violent move. The chart becomes a language. And once you learn the language, you stop hearing noise and start hearing intention.